Okay, thank you, Yudi, for your generous introduction. Well, weren't we entertained with that little exercise in PowerPoint and Zoom technology? Weren't we also entertained with the US election? I really like this slide because it kind of sums up the two options that were given to the American people about who they would choose as their next president. And it kind of reflects what the American electorate kind of looked like leading up to the election and after the election. Kidding aside, without getting into details about each candidate's stances on the key issues of facing American society, the American economy, or anything else, I think this was a classic geriatric weight bout. The weigh-in, which is what I use as the term for the speeches and the debates, there really wasn't much to recall. They were pretty forgettable, other than the one quip from Biden that said, "Man, shut up," or "Shut up, man," when he directly told Trump to stop talking about himself and get focused on the issues at hand. But again, the options weren't really great, and it took quite a while for the ballots to get counted and everything else. And finally, Biden was able to give the knockout blow, but only 5 days following the election. In the end, the results were what was predicted, a Biden victory, just not in the magnitude that was expected. It was a much closer election than anyone really thought. And it took a while to get all the results in. I think they're still counting some of the results with respect to some of the Senate and House of Representatives positions. The pundits expected a huge voter shift towards the Democratic Party and what they call the blue wave, and Biden to basically crush Trump, but that is not what happened. Actually, I think that the Democrats lost some of their seats in the House, and the Senate kind of still remains in Republican hands, although shakier. And Biden did not crush Trump. It was a much, much closer battle than people anticipated. But in the end, Biden did deliver the knockout punch, and we're still waiting for Congress. This actually, if Congress stays divided, with the Republicans controlling one house, the Senate, and the Democrats the other one, this could be the Goldilocks scenario that for anybody, for the markets, would be perfect, because no president then can do radical changes, and he's got to work with both parties, which means he's basically got to work with the whole spectrum of American society. Now, this morning was the first trading day following conclusive results that Biden won the presidency, and we saw a huge pop in index futures this morning. Some of it was due to the resolution of the presidential election, but I think mostly it was due to Pfizer announcing that their COVID-19 vaccine proved 90% effective in trials. And so they're still developing that. And you can see the massive pop in the Dow futures and the S&P futures this morning before trading started. NASDAQ futures, a little more muted, but that's the exchange that was actually running up very hard all year long, irrespective of COVID situation. Here we can see the futures markets with respect to crude oil. You got your West Texas Intermediate on the top line, up almost 10% before markets open. Brent crude, which is the European crude, up almost 9%. Gold, which is your risk off trade, was down pretty heavily. And then you get your Dow futures and S&P futures in numbers. We saw the charts on the earlier slide. So given the results of both the COVID-19 vaccine announcement by Pfizer, and we know who will be president for the next 4 years, it's risk on, is what the markets are indicating for us, at the very least for today. What this chart shows us is two bars. One is a light colored bar, one is a dark. The light colored bar is when the incumbent party wins the presidential election, and the darker bars are when the incumbent party loses the presidential election. And so the line here basically shows how up to election day, and then 1 day after, 1 week after, 1 month after, and then the periods after. So irrespective of the incumbent party winning or not winning, you actually have a pretty strong market rally 1 year after. The light colored bars indicates that if the incumbent party gets re-elected as president, you get a much stronger rally in the markets. The reason is that markets like stability, they like continuity. In this instance, because of all the disruption that Donald Trump had caused and policy by tweeting and making announcements through Twitter rather than in the proper channels, his disregard for addressing the media appropriately, his constant concern about not being fairly treated by anybody, I think just wore thin with everybody. And Biden may be the guy that brings stability and continuity more than Trump does. And so we actually may see a stronger market rally under a Biden than under a Trump, which would go against traditionally what we've seen. But irrespective of that, dark bar, light bar, 6 months after, 1 year after, we see a rally in equities. Here's another way of looking at how the stock market performs. Here we're using the Dow Industrial Average. And when you're looking at the year four, so this would be Trump's 4th year, period 1 here is October to December. You generally have a positive. Almost all period 1s in any presidential cycle are always positive, and that's probably driven mostly by the Santa Claus rally. The magnitude of the rally will be determined by policies and such, but generally markets tend to rally into the end of the year. The first quarter of any new calendar year is your period 2, so that would be when Biden swears oath, January to March. Generally, historically, you've seen positive pop in the market. So that would be over here. And then you've got your 3 very strong, actually here is kind of slightly negative, but you get a really strong 4th quarter. So this is Trump's last year, October, November, and then bang, you get this, after this drop, you get a really strong pop. What it's just trying to demonstrate here is that irrespective of who is president in the presidential election cycle, you have more quarters of strong growth and very few negative growths. And the strongest ones are when new policies get introduced, you get very strong quarters. Second year tend to be much more muted. And this is because this is a midterm election year where parts of Congress get reelected or parties change control of the houses, and so policies become much more watered down or more difficult to pass. Once the houses all get settled, you get a very strong rally, and this is what we saw in 2019, very strong rally, even though President Trump was constantly against Congress, but still the markets were very, very strong and very growth oriented. And a lot of that had to do with some of the policies that Trump was actually able to get through. And that included cutting corporate taxes, which I think was one of the biggest things. Here, when you look at this, it doesn't matter who's really president. You generally have rallies in markets. And the reason is that the pressure of money. Each and every year, more and more individuals are entering the workforce, more and more individuals are setting aside savings for their, in the States, 401k plans, or in Canada, RSPs. More and more people are saving for their children's education. More and more money is being set aside in insurance policies, property insurance, as households are formed, and that money's got to go to work. It's got to go to work, and it's got to go to work in the markets. And that's why you generally see, here's a chart of the S&P 500 under each president. You'll have some periods where things don't go so well during an administration. At the beginning here, you see Coolidge and Hoover. Well, you've got the Great Depression coming after the market crash of 1929, which caused the Great Depression. A lot of people were out of work. You've got the run up into World War II. And then after the war is over, you get this big market rally that lasts all the way up until the 1970s. That's just basically a switch from armament production to consumer goods. Households are being formed, soldiers are coming back from the war, families are being formed, houses need to be built and lived in, they need to have appliances, they need to consume things, and you get this big run up. The period where Nixon and Ford, you basically have the Vietnam War needing to get unwound. Nixon came in deep in that war. It took a while before they were able to unwind that, but at the same time, you had the big oil embargo and a huge, massive leap in the price of oil, which caused massive inflation, interest rate hikes, and that really took the wind out of equity market sales. After that, you get the Carter, Dems, and then Reagan's big deregulation push, which the biggest impact was deregulating the telecom sector. And all of a sudden, after the telecom monopolies were broken up, you had this massive creation of new companies, cell phones. You also had the introduction of computers, home computers, personal computers, and then the internet. And that just had this massive rally right up until the beginning of 2000 when you had the dot-bomb bust. Bush Jr. had to deal with the Iraq war. And then the Obama administration came in, you had another rally. Basically, all the technology and deregulation that occurred up to that period of time became materialized into real companies that had strong growth trajectories, revenue generation. Your Facebooks, your Amazons were no longer .coms like they were over here. They actually became real companies with real revenues, employing real people. And you had that building economic growth and market growth. And then Trump carried it on. His big thing was the cutting of corporate taxes. So irrespective presidential election years, a new president is elected, incumbent is elected, the average between the two doesn't matter. Stocks always outperform bonds, and on average by double. And that's just because stocks are growth, bonds are very stable and just income generating. Stocks are risk on, bonds are risk off, and generally risk on tends to outperform. And we can really see that risk on, risk off with how the price of gold actually worked. There was a lot of risk off. Gold prices were running, not so much risk off at the beginning of 2000, except when COVID hit, then you've got the big risk off. But as trepidation started entering the mindset of investors with respect to the presidential election, a lot of expectations that, you know what, got a decent run, let's get out of the market and take risk off and go into a safe haven. Well, prices in gold actually went down. So that trade absolutely did not work. So gold prices dropped between August peak to the beginning of the election. Gold prices came down here. So that safe haven didn't behave that way. And U.S. Treasuries, the same thing. Over here, you've got your August low with respect to Treasury yields, which means prices were at their highest. And as the yields rose, the price of Treasury notes fell. And so again, getting closer to the election, you would think people should be nervous, get out of the market, we see where it goes. This yield should have gotten tighter and tighter as money was flowing into bonds as a risk-off trade. That actually did not happen. And so, which brings us to this slide, which I think is quite important because a lot of people have been thinking about, okay, if we do have a Biden presidency, how's that going to differ with respect to Trump, and especially on the major issues? First thing is stricter COVID-19 controls. This may become a non-issue if what Pfizer announced earlier today that they do have a vaccine may actually negate this issue altogether because there may not be any more controls. If the vaccine gets to market quickly and gets distributed, there may not be another lockdown. And so this could just be a positive for both short-term and long-term. We'll see. Tax increases, definitely all the spending that's happened, and also the anticipation that the new administration will work together with Congress to launch a huge, massive stimulus program to get the economy up and running again, is going to have to get paid for somehow. And so longer term, that's a negative, and it's a double negative for equities because tax increases take disposable income out of investors' hands, and so it won't go into the market, it'll go to the government. Fiscal stimulus is an opposite effect. That money may actually go back into the economy, may help create jobs. So you get a big positive on equities, positive on bond yields. But really, this fiscal stimulus, depending on its size, could be big. Given the fact that stricter COVID controls may not be necessary, perhaps this fiscal stimulus could be smaller because the economy could be opened up more fully sooner rather than later, and therefore the excessive government spending may not be needed. Also, given that Congress is mixed, you didn't get the Democratic blue wave. The president and the House of Representatives may not be able to pass as massive a spending plan as they had originally hoped if the Senate stays in Republican hands. Trade and immigration is going to reverse from the negative of the last 4 years to a positive. Regulations, industry regulations, sector regulations is viewed as a negative under Democratic administrations. So overall, should be a positive, driven mostly by the fiscal stimulus and perhaps the non-requirement of a further lockdown. And so that's quite a good sign. We don't know what the impact will be on equities overall, but the sense is that it should be a positive. We can see that it's positive on the economy. It's expected to be positive on the economy, both short and long term. And so if it's positive in that sense, it means corporate revenues and corporate income should be able to grow, and that's a positive overall for stocks. Tax policy is probably the biggest issue that investors are going to be watching, especially institutional investors. And thinking right now goes that if there's a Democratic sweep scenario, higher tax rates is going to affect sectors that currently have a low effective tax rate, much less than ones that have a higher tax rate. And so here you see at 59%, the highest tax rate sector is energy, followed by consumer staples, materials, industrials, and telecommunication services. That's your front end here. At the back end, with the lowest effective tax rates, you've got real estate, information technology, utilities, and healthcare. And so these sectors, even if there is a big jump in corporate taxes, may still outperform because they may be less impacted by it. And so here you can see the top three sectors with respect to low tax bracket. You got real estate, technology, and healthcare. High tax bracket, industrials, consumer discretionary, and energy. So it's kind of surprising to see energy really pop today. And that's probably because of the fact that if the economy doesn't have to go into lockdown, consumption of fuel and energy in general is going to go up, and that boded well for prices. The other thing that was really big that happened is over this period, especially over the last 20 years, is growth has completely outperformed value. So this is just a relative performance of the S&P 500 growth sector versus the S&P 500 value sector. And growth has never been stronger relative to value than it is right now. Where value tends to be cheapest and has the opportunity to totally outperform is generally when you have a big readjustment in the stock market. Here we had a recession in the late 80s, early 90s, which made value now the trade. Money left growth. There wasn't anything to grow in a recession, so people shifted to value. Same thing here after the dot-com turned into a dot-bomb. All of a sudden, value became the play. But here, I don't know. I mean, the technology has been very strong, and these technology companies that had their technology in its infancy back at the beginning of the new millennia have now become mature companies. They know how to extract revenues and generate earnings out of it. And so maybe this growth is still going to get rewarded. Over time, growth is always more rewarded than cheapness. And so if you can grow revenues, you can grow earnings, you will outperform. One of the other interesting sectors and plays with respect to a Biden presidency is clean energy. A lot of talk. The Democrats are generally the leaders on the fight against fossil fuels. They want a clean energy economy. They want to see more electric vehicles on the streets. Not that Trump was against it or the Republicans are against it, but it's just viewed that the Democrats are more green than the Republicans are. And so the S&P CANSO Clean Power Index relative performance to the S&P 500 index is this green line down here. And the blue line is the odds-on probability of Biden winning the presidency. So as Biden's odds improved and the probability of him winning increased, the outperformance of the Clean Power Index relative to the general market index followed in the same trajectory. So it's viewed that clean energy and anything tied to it, electric vehicles, battery metals, your lithiums, your cobalts, your graphites, your nickels, your cadmiums, your rare earth metals, could be wind energy, solar energy, thermal, that kind of stuff could be big outperformers. And so that may be a sector that would be interesting for investors. And that kind of leads me into my concluding slide, which basically is the crux of what all investors will be focused in on, is what are the sectors that have the best potential of outperforming under a Biden presidency? And here, healthcare and pharma, very big. I listed some ETFs. This way I can avoid going into individual stocks. And this allows you to kind of focus in on the sector that has been touted by different pundits as potential big winners under a Biden presidency. And so in Canada, ETFs that trade in Canada, I carry these symbols. On US markets, carry those symbols. Vanguard, Fidelity play big roles in ETFs, as does Horizon and iShares. So clean energy, electric vehicles, this Canadian one actually isn't related other than tertiarily. This is HURA, which is the uranium ETF. If electric vehicles become a bigger player in the general automotive sector, and we move from less than 1% electric vehicles on the road to something 5, 10, 15%, in order to recharge those vehicles and to have power charging stations throughout cities, provinces and states and things, and they require a lot of electricity to recharge, especially if you want fast recharging. You don't have to sit for an hour or two to recharge your vehicle at a filling station. You can get it done in 10 to 20 minutes. It's going to require much bigger base load than what currently there exists. The only thing outside of fossil fuels that can provide base load power is hydro and nuclear. You cannot use solar or wind for base load. You got to use nuclear, and a lot of the nuclear reactors in the United States, which has the largest nuclear fleet in the world, has been extended. Their life has been extended, and so uranium suppliers could play a big role. That's the only way I could see playing the clean energy card in Canada. In the States, there's a lot more options. UDI is their version of uranium, but the other two are actually more related to clean energy, metals technology companies, and things like that. Technology has been a huge outperformer this year. Here's 3 different ETFs in Canada and 4 in the United States. The one I'm most familiar with, I don't know why the slides keep jumping on me, is ARC. You can get mutual funds that also reflect this. Fidelity's FTech and Vanguard's VGT are other alternative ETFs that you can buy with respect to tracking technology. Financials, the big underperformer over the last 2 years has been the financial, especially the banking sector in the US and Canada. They may be benefiting from a big economic rebound, especially if we don't have to go into another COVID lockdown. And so US banks are tracked by this ETF. This ETF will track the other banking sectors. In the US, you've got the Vanguard and the iShares. Also, by Canada. Canada's relationship with the United States should improve. It should improve not just in foreign affairs or in cultural affairs, it should also improve in economic and industrial affairs. And so perhaps much less trade friction that Trump introduced will happen under Biden. And so just buying Canadian ETFs, value, growth, dividend payers, the TSX 60 could be a way to play Canada as an outperformer relative to the US. Big stimulus in the United States. If it is big, then you just want to buy the market, the S&P 500, the NASDAQ, and then in the States, if you want to buy their versions, you can look at those ETFs. Oil and gas. It was originally the thinking was that oil and gas as a fossil fuel would be a negative. But this morning it really popped, and I guess it's just based on economic growth. If the economy grows, people will be flying again. People will be driving again. People will be vacationing again. That means consumption of gasoline and other fuels is going to go up, rebound. There's been a lot of pullback in production in order to match with the drop in demand. But if demand really shoots up, that could be a big driver of higher prices, higher revenues, and profitability for the oil and gas sector. And so those are the ETFs you want to be looking at. And with that, Yuri, I will wrap up my presentation.
All right, thank you, Michael. That was very interesting, much as the election has been over the last week or so, as everyone was glued to their TV seeing what's going to happen. Couple of questions, and if anyone else has questions, please feel free to type them into the chat box, and we'll answer them if we have time. So first question is, why do people buy bonds if they underperform the equities market? What are the good reasons for buying a bond?
So very often bonds are bought by institutional investors for asset liability management. Not just asset liability management, but asset liability matching. So large insurance companies, pension funds, they have to match their liability, and the best way to do that with certainty is to buy a bond. Others buy bonds with respect to just having diversification of assets. And there's diversification theory that says if you're properly diversified, you can minimize your risk and maximize your return for any given level of risk. For most individual investors, that safety trade is great later on in your life cycle. When you're already into your pension years and you basically want to protect the wealth that you've generated, you go into bonds or equivalent fixed income like GICs or things like that. However, they never perform better than equities. And so if you're young, I understand the thinking and the psychology behind wanting to buy a safety asset, but you will always underperform. Being young, you don't have the experience. You made your first money, you're really excited about it, and you don't want to lose it. You want to maintain it. Your youth is your risk-taking years. That's where you should be really focusing in on taking intelligent risk, not just willy-nilly buying whatever stocks, but thinking things through, doing some research, but really focusing on the ability to grow your wealth, because it's in your younger years that, one, you have the ability to rebound best from mistakes. And so that's when you should, develop your approach to investing, develop your approach to building up your wealth and your asset base, and not being afraid to take calculated risks, because you have your best ability to rebound from them. When you get older, you get more experience. I find more people become more risk tolerant the older they get, because they now have that experience working for them. but they miss out on those early years where they could have really made a lot of money up front. But again, you know, everything costs. Nauka kosztuje, to use a Ukrainian term. Just basically, you got to pay for everything, and you got to pay for your education and experience. So trying to avoid that maybe give you peace of mind and let you sleep at night, but it doesn't really allow you to get too far ahead. It's a little bit of a long-winded answer, but hopefully that covers what the individual is hoping to glean.
Okay, thank you. And also, you used a couple of very sort of, I guess, interesting but industry terms. If you could, you maybe define some of them. One of them is, what's a Santa Claus rally?
So a Santa Claus rally is generally, you get a market rally near the end of the year. And they call it a Santa Claus rally because Christmas comes at the end of a calendar year. And what happens is prior to that period, if you own a stock in a taxable account and it's been underperforming, like many may have throughout this year, you would be selling them in November. You would then be buying them back 30 days later, because let's say you like the stock, but the market was horrible because of these extraneous events, COVID, economy lockdown, U.S. presidential election causing turmoil. You don't want to be in the market, you're down. So you sell it at a loss. You realize in a taxable account a capital loss that you can apply against past or future capital gains. So you get some benefit out of doing that, but you still like the stock and you want to own it. You got to wait 30 days to buy it back. When you do buy it back, it's happening in December. That's your 30-day period. And so if you have a lot of this happening among the whole universe of investors that are out there, you get a lot of drop in the autumn, October, November, and then you get this big pickup in second half November and through December. And because that big pickup in stocks, as all this money is coming back into the market to buy back those shares that were sold earlier, you get this rally. It's called a Santa Claus rally. You also have mutual fund companies that would love to have their mutual funds close the year out on a high. So if they have any excess cash available in their funds, they turn around and start buying up the stocks, and that helps the overall market value of the fund improve, grow, and it looks great for year-end statements.
Okay, thank you. And so during COVID, a lot of, it seems like almost everything took a huge dive, but a lot of industries have, roared back and even done better than they did before. Aside from the financial industry, which is still quite heavily off, what else is still undervalued compared to what it was at pre-COVID?
Pre-COVID, yeah. For sure, your financials, your REITs, real estate investment trusts are probably, they're part of the financials, but they're a little bit more separate in the sense that they don't live off of net interest margin like banks do. Insurance companies also have been off, but the really big ones in the financials are the REITs, because the fear of renters, whether you're a company leasing office space or a dentist leasing his practice space, you were forced to work from home. Maybe you can now use technology and not bother going back. You may not renew your lease. And so those, the fear that, oh my gosh, people are not going to pay their rents, they're not going to go back and release, they're going to have all this empty office space, nobody's going to shopping centers anymore, these little stores are going to renege on their lease payments, et cetera, caused a lot of depression in those stocks. Energy stocks just been clobbered. Why? Not much demand. People are not driving every day. At the beginning of the COVID period, 401 felt like a ghost town, like dead empty. You could travel 200 kilometers in like 45 minutes. I jest, but I mean, that's what it felt like. As the economy gets back up and running, and if it's true, we don't need to go into lockdown anymore because we do have this vaccine, then more people will be brave enough to say, okay, I'm going back into work. I'm going to be driving again. I'm going to take that vacation. I'm going to fly. I'm going to book my flight, etc. I'm not going to be scared to be on a plane, encased in that airplane with 300 other people, coughing, sneezing, and carrying on. I'm going to catch something. No, I'm not, because I'm vaccinated. I feel fine. Everybody else is vaccinated. No need to worry. COVID's gone. So you get this big run up in energy demand. And so oil and gas companies could benefit well. Also retailers. So a lot of the retail shops that were getting the Reitmans, and those may see a nice rebound as people are now going back to the malls, back to shopping. Your consumer discretionary sector could see a nice bounce back again. They're probably trading at a bigger discount than some of the other sectors.
Okay, well, thank you very much. I don't see any more questions, so I hope folks who have additional questions, like I said, you could always contact Michael directly. If he can answer your questions, he will do his best. And of course, if you have a portfolio with him, great. If you don't, please consider opening an account and taking advantage of both Michael's and his team's knowledge if you yourself don't feel as comfortable in making these financial decisions. Thank you very much, Michael, and hopefully we'll hear from you again in the new year on some additional topics.
Okay, thank you, Yudi, and thank you to our listeners.
Thank you.